All right, I want to thank everyone for joining us this afternoon. For anyone on today's call that I haven't met, I'm Lindsey McKay, the lead advisor at McKay Wealth Management, and we do quarterly economic updates in order to help clients stay abreast of what's happening in the market. There's a little bit of what's happened, kind of to this point in the year, but then also what are we thinking about as we turn the corner and are moving into the next quarter. So we frequently are joined by different organizations as far as sharing some of the knowledge that they have from their research and the best and brightest that they have at their organization. So I'm excited to once again welcome Justin Sidhu, who's from JP Morgan. And JP Morgan does a very robust guide to the market. So many of you who maybe have assets with them have seen this come out, but it's about 70 slides maybe of info economic data that they're putting into charts to help kind of support some of the trends that they're seeing, information that's coming out, and really kind of help us in the industry make sense of all that information. I promise you, Justin is not going to go through all of those slides today. We've handpicked a few that seem relevant to what's currently happening, but there's obviously just always a lot of information out there. So our goal is to try and bring it down to a few slides for us to go through and kind of talk about some of those major points. So with that, I'm going to turn it over to Justin. And I guess, Justin, you can share if there's people are interested in more information, if there's resources that they can access directly to get more of those 70 slides that I referenced.
Thank you, Lindsay, and good afternoon, everybody. Thank you for joining. Yes, we will be sharing our guide to the markets today. It is a resource that is publicly available on JP Morgan's website. That's jpmorganfunds.com. So if you do feel compelled to want to go through more than the 7 or 8 pages that we will be going through today, to Lindsay's point, it is about 70 pages. It is updated daily on our website, and so if you feel compelled to wake up on a morning with your cup of coffee and want to dive into the markets and the economy, have at it. As we move on to the first slide in our slide deck today, it's interesting. I was talking with Lindsay beforehand, and the last time we had all gotten together to discuss what was happening in the markets was actually late January of this year. And at that point in time, as an investor, we were sort of guessing in terms of what could transpire with the new administration coming into play and what sort of policy changes were going to transpire. And the market hadn't really had a time to absorb or react to a whole lot of that at that juncture, early or late January. Couple of months later, as the market began to digest the potential impact of what tariffs would mean, that became the sort of the buzzword. You couldn't get by as investors a day without thinking about what the tariff impact would be to the market and to the economy, and would tariffs bring about a recession to the U.S. economy? And so from about January until now, we have sort of had as a market, as an investor, we've been sort of dealt this blow of like, well, we're going to get tariffs and it's going to bring about a recession. It's going to be very painful. And then naturally, as the market tends to do, which is overreact, they sort of say, okay, this is going to be the worst case scenario, and there's a lot of doom and gloom. The market reacts. And then once investors digest that news, and they sort of realize, hey, maybe this isn't the end of the world. Maybe things aren't as bad as perhaps what was perceived. And then the market has kind of come back. So, truth be told, had you have all gone away on an island for the last sort of 5 or 6 months and come back again, what you'd actually have found was that the stock market between January and today did experience a pullback, the US stock market, of almost 20%, which is known as a bear market. It was down about 19%. I'm happy to share, as you'll see on this chart, which is the S&P 500, that the stock market is not only not down 20% at this juncture, but it has rallied all the way back and is actually through about today up almost 8% on the year. And so it's really important for investors to separate what has been a very noisy year, right? I mean, this is maybe been even noisier than others. We always get noise, but there's been a lot to digest this year. But it's important for an investor to separate the noise versus the reality of actually what has transpired. And the good news is, like we're almost at all-time new highs on the stock market. In fact, we've had 8 all-time new highs this year already. But what has driven that has been this continuation of an economy that didn't roll over. It didn't go into a recession. You've had corporate profits that have been very, very strong. You've had a consumer that has continued to spend money, and quite frankly, optimism in the future that has just taken hold and allowed these markets to get to where they've been. So we've had a resilient market so far, even in the face of a lot of noise. Now, if we look at the next page, if we were to actually take a peek here at what volatility has felt like, which is never fun when we go through periods and pockets of volatility for the market. It does tend to be quite a nervy time for investors, and we're always questioning how bad can this get. This is one of our favorite pages in the guide to the markets to reflect upon what volatility looks like each year. There's rarely a presentation that we get through that doesn't have this page in the deck, and so it's just a good visual, an important visual for investors to take and get a sense as to, well, what volatility like each year, and how does the year actually end up? And so this is the S&P 500 again. It goes back to 1980. And you're going to see two data points on this chart. The purple dots reflect what the biggest pullback was in the market for that year. So as I just mentioned, all the way off to the far right, you'll actually see the pullback that we've had this year, all the way off to the far right, was down 19%. So that is what the purple dot indicates. And every year you see a purple dot. There's never a time in any given year where the market just goes up and up and up and doesn't have some sort of pullback for some reason. Now, there are worse off pullbacks in certain years than others, right? We only had an 8% pullback all of 2024, only a 10% pullback all of 2023. But you will see some times on this chart, like 2022, where we had a pullback of 25, 2008, down 49, a particularly painful year for stocks. But the other data point is the gray bars. Actually, how did the year finish? So not the intra-year pullbacks, which is what the purple dots would indicate, but actually how did the year finish? And as you can see up on the top left, despite on average an intra-year pullback of about 14%, right? That's the price that we have to pay as investors for being in US stocks. We're going to experience volatility, we're going to experience pullback, and that average pullback is about 14%. But the more important number for an investor are the gray bars. And that shows here that the annual returns have actually been positive in 34 of the last 45 years. It's baseball season. If you do the math on what that looks like, that's like a baseball player hitting a batting average of 750, right? And there has not been a baseball player in the history of baseball that has hit 750, but the U.S. stock market has. And so despite these pullbacks, despite the fact that, every so often that baseball player may strike out, we are much more positive than we're not, to the tune of 75% of the time. Maybe put another way, growing up in Ohio, I grew up in Cleveland. My dad would watch a lot of sports, and he'd be watching the game, he'd be watching his team, and he would uh, inevitably at some point in time, there would be something that goes awry with his team. They're losing, and he turns off the TV. And he would march outside and he'd go cut the grass or he'd go wash the car. He was doing anything but watching the end of that game because he felt like his team was ultimately going to lose and he didn't want to feel the pain of that. Now, in so many occasions, turning off the TV is not the right play because that team could come back and actually win the game. And there were so many times my dad would walk back in the house and we'd say, "Hey, Dad, did you hear about the game?" And he's like, "What do you mean they lost?" And in fact, they didn't. And then he was equally frustrated by the fact that he missed the ending of what was actually a celebratory moment. That is exactly what investors do when we experience volatility. When we have these 19% pullbacks or 49% pullbacks, 20%, whatever it may be, oftentimes investors are akin to turning off the TV. And what they do is they actually sell. They want to get away. They don't want to feel that pain anymore. And the problem with that is that as this chart shows us, this market has an incredible resiliency in bouncing back again and actually winning the game. And so we want to stay tuned to all four quarters of whatever game that we're in, whether it's a basketball game, a football game, or in fact the four quarters of a calendar year of stocks. And this year is no different. In fact, we've never in a year before had in the first 6 months of the year a pullback to the degree that we did of that 19, almost 20%, and actually still finish as of June 30th, +5 as we're seeing on this chart. And so it's a good reflection as to what volatility looks like. It's the price that we pay for being in stocks, but we're winning a lot more than we're not. Now, if we look at the next page, it is important for us to sort of get a sense here as to what we deem to be a little bit of an issue, I guess, a risk. And this is why we really preach diversification. And that's that when we're investing in stocks and specifically, let's say, the S&P 500, and we use the S&P 500 as a benchmark because it is truly the makeup of 500 of the largest companies in the United States. And so it's a good barometer for how this market may be looking and how the economy may be looking. But it's not sort of an equal weighting across all of these different companies in the S&P 500. And so what's actually been interesting over the course of the last few years is that there's been a handful of companies, specifically tech companies. You'll actually see them in the footnotes on the bottom of this page, some very household names that have gotten very, very large in size. That the market capitalization of these companies, quite frankly, because of how well they've been doing, has continued to sort of disproportionately uh, weight the index a certain way. And so you've got maybe more tech than you do another sector. You may have more companies than you do others. And that's fine when these companies are doing very well. And they continue to do well this year. But the point being on this chart is that um, if we look off to the right-hand side of this chart, by a market capitalization, those top 10 companies in the S&P 500 today, they actually make up, and again, there's 500 companies here in the S&P. Those top 10 make up almost 40% of the index. And that is a theme that has been prevalent now for the last 2 or 3 years. Again, a lot of tech companies, a lot of the AI theme, the artificial intelligence theme that has sort of driven these stocks to new heights. But it is potentially a risk, we think, from that diversification point of view. If I were an investor investing in the S&P 500, I perhaps would think that I've got equal exposure or a good amount of exposure in all the companies of that 500. The reality is that the top 10 make up almost 40% of that index. And so this year and leading up to this year, and even where we're at right now, if that concentration risk for an investor is maybe a little bit too much than what they would like as far as maybe a lack of diversification, then there are other opportunities. There are other sectors that we've been investing in as a company. It could be financials, it could be industrials, it could be healthcare, it could be some staples or consumer discretionary. There are other sectors above and beyond just tech to help balance out and diversify ultimately this U.S. equity picture, which has been so strong. This is not a knock on tech companies. It's not a knock on the AI stock by any means. It's just simply a question of how much of these companies do we want to have, and are we actually aware that we have so much of them in an index, and are there ways that we can diversify? Now, if we look at the next page, One shining light this year that we have not seen in previous years has been this idea that there are actually markets outside the United States that are doing or could be potentially doing okay. Now, if we had had this discussion around international, more or less on in any other year going back to 2008, we're talking 15, almost 20 years here, then the U.S. equity market had been so resilient, had been so strong. The U.S. economy had been so strong that it was tough to find any optimism behind investing outside the United States. Those equity markets exist, and it's important to diversify again. But you found a lot of investors in the United States saying simply, why should I have international when the U.S. stock market is doing so well? I don't feel like I need to have that. And that was the case actually. That story worked very well for many of the last 15 or so years up until 2025. Now, something that the rest of the world is not dealing with that we are here in the United States, and I sort of alluded to that a little bit on the previous page, is that when we've been doing so well for so long, you do tend to start asking yourself the question of, well, are stocks expensive in the United States? And for the last couple of years, the U.S. equity market has been deemed to be quite expensive. Now, the companies that we are investing in have continued to do very well, and so they've been able to maintain these lofty expectations that Wall Street has put on them. Again, specifically some of the artificial intelligence companies that have continued to sort of just rock and roll. But this year, investors have at least begun to ask the question, wait a second, if we continue to get some tariff concerns, which we'll address in a moment, if this U.S. equity market is a little bit expensive or a lot expensive, again, if I'm diversifying my portfolio, are there some other places that I can go to outside the US to do that? And fortunately, this year, the rest of the world is actually waking up. It's taken a long time. They've been on a long nap, but they're actually finally waking up this year. And what is very interesting off to the left-hand side of this chart is the fact that over the course of about the last 2 to 2.5 years, the green line is Europe, the blue line is Japan. These are regions that, when we think about investing internationally, these are making up the lion's share of that international trade by and large. And then the last line is the gray line, which is the U.S. stock market, but it's taking out one stock, which in this case is Nvidia. And what is very interesting is that over the course of the last 2.5 years, just excluding one stock in the US stock market, Europe and Japan have actually outperformed the United States. And so this hasn't just been a 2025 story in many ways. We've actually seen the strength of Europe and Japan a little bit more so over the last 2 or 3 years, but overshadowed by the fact that one particular company here in the United States, a chips company, obviously, and NVIDIA, the AI story has overshadowed that. This year, with certain AI companies or tech companies just falling off a little bit at times throughout the year, it has allowed these other regions of the world to do well. And it is something in our portfolios that we continue to be optimistic around. And so it is not just a US story moving forward. We can have some optimism behind places like Europe, Japan, even emerging markets. And when I mean that, that's the Chinas of the world, the Indias of the world. They've all kind of collectively gotten through some of their problems over the last few years. And that has really sort of provided an incentive for investors to start to look at parts of the world again. Our chief market strategist is JP Morgan. He had a quote one time, and he mentioned it's hard to hurt yourself falling out of a basement window, right? And if you think about certain asset classes in the world, that are much cheaper than others, if they're already sitting in the basement, and you could look at international potentially as an asset class that has been sitting in the basement for the last handful of years, it's hard to hurt yourself because you can't really go a lot lower, right? And whereas the U.S. stock market has done so well, the U.S. stock market isn't in the basement. It's sort of in the attic, if you will. It does have some room to drop if things didn't align. And so the point of this page, or just some of the last couple of pages, has been there are other places to be as investors. A balanced view, a diversified view at this point, at this juncture of where we're at, we think is a really important view to take, and could continue to be this way as we continue throughout the rest of the year. If we look at the following page, what we've just looked at is sort of a summary of U.S. equities and world equities. And there's no reason to say that this train that sort of has left the station a few years ago is really truly slowing down. It would take a lot for the U.S. economy or the U.S. equity market to really slow down, tremendously or really go backwards for a sustained period of time. But it's really important for us to sort of get a sense as to what the U.S. economy is doing because you don't get one without the other. You don't get a stock market that's doing well if the U.S. economy is cratering. And vice versa. You don't generally get a U.S. economy that's growing nicely and seeing a U.S. equity market really drop a lot in a sustained period. And so if we take a quick snapshot here of what the U.S. equity market looks like, we have continued to grow in 2025. Once again, at the beginning of this year, there were certainly fears around this idea that tariffs would take such a chunk, such a bite out of, you know, uh, corporate profits and the ability for people to consume because prices would be going up. That was the real fear behind tariffs, was that prices would go up so much that consumers would really eventually feel so squeezed that they would stop spending. Thus far, we haven't seen that. Now, part of that reason is that for the first few months of this year, companies were getting a sense as to maybe what the tariff impact would be, what the level would be, and how they would go about doing that. Now, if you were a company that imported a lot, which a lot of U.S. companies do from abroad, what you did happen to see in the front half of this year is that corporations just really front loaded their inventories. They said, hey, if the tariffs are about to hit in April, and today is February or March, then let's just order a lot more now, and before the tariffs come into effect, so that we don't have to absorb that tariff in some manner. And that's what you essentially saw in a big way in the front half, the first half of or the first few months of 2025. And so what that has effectively meant is that some of the tariff impact, remember, if you're a company and you are now paying a tariff at the port of entry for the goods that are being imported from somewhere in the world, if you're a corporation, you've got two decisions to make, or one of two decisions to make. One is that you are going to absorb that as a company, you'll absorb that tariff, which for that company could be bad news, right? Because we've just talked about the strength of corporate profits and the strength of corporate earnings so far this year. If they eat all that tariff, then that probably means that those earnings growth or the earnings of that corporation likely would come down some. The other way that a tariff could be effectively absorbed is to pass it along to the end consumer. And that is more likely the case of what is going to potentially transpire here in the second half of this year. And so if we've sort of felt so far that things haven't gotten much more expensive than perhaps what they already were, and for what it's worth, stuff's pricey. Going to the grocery store, buying an airfare, buying a concert. I mean, you name it. The things are pricey, but to the extent that they've gotten a lot pricier due to tariffs, maybe not necessarily been impacted just yet at this juncture. That could be something we feel at JP Morgan. That could be a second half of 2025 story where some of these prices effectively start to increase. And then it will really be a show of strength to the extent that the consumer can hang on. Now, if we look to the right-hand side of this chart, the reason I keep talking about the consumer in such a way is because that big blue shaded area indicates how much the economy is reliant on consumption. It's about 70% of how the US economy grows. So far, we've sort of felt like this year's economy has been what we would consider to be a slow, healthy tortoise. What that means is that the economy is growing. It's not going backwards. It's just not growing at an exuberant rate, right? We've had a couple of years of solid economic growth, and this economy was bound to slow down a little bit in and of itself anyway. If you do layer on tariffs in a bigger way in the second half of this year, then obviously something we're focusing very closely on is the impact of consumer spending, knowing how important the consumer is to the overall economic picture, which you see here on this page. And one of the bigger impacts of that is going to be inflation. We've been trying to tamp down inflation over the course of the last 3 or 4 years after it spiked. And I think that actually, I'm not sure we've got a chart on this. Yeah, it's the very next chart that we've got. You can see the progress that has been made on inflation over the course of the last 3 years. If we were sitting here having this conversation in June of 2022, inflation had peaked at a high that we hadn't seen in 4 decades at 9.1%. Remember, ever since like 2008, this economy growing at that slow, sort of healthy tortoise-like rate, inflation was never really much of a concern up until what we saw up in 2022. And so for the last 3 years, the Federal Reserve specifically has been doing everything it can to bring down inflation, and that has meant higher interest rates. It's meant essentially taking as much steam out of the economy without putting the economy into recession. And so we could argue that the Fed did a really solid balancing act of that over the course of the last 3 years to get inflation down to what we see on this chart at the end of May of about 2.5%. Now, last week, a new CPI, a new inflation report came out that did show that inflation did perk up a little bit in June to 2.7%. It was kind of in line with where people were thinking. Our expectation at JP Morgan is that this inflation rate is going to continue to perk up throughout the course of the year, and maybe we'll be closer to about 4 or 4.5% by the end of 2025. And so a lot of that has to do with the tariffs. Other sort of variables within that is restriction on immigration. If we're starting to lose a little bit of the working age population in the United States, whether that be simply baby boomers retiring or some of the restriction on immigration at the border, then obviously employers are going to have to backfill those jobs potentially and pay a higher wage. So that in essence is also inflationary as well. So these are a couple of the risks that we would anticipate seeing in the second half of this year. Obviously, so far it has been better than expected, as we saw in the first handful of charts that we've seen on this in this deck, and we always say you never want to bet against the U.S. economy because it's certainly more resilient than it is not. But we also have to be realistic to this idea that there could be things that derail the economic story. There could be some things that set stocks back a little bit, and certainly tariffs, certainly a pickup in inflation again. Could be a couple of those. And so it'll be really beholden on the companies that we invest in again to continue to be able to put up the numbers that they've been able to put up in the front half of this year. And if that is the case, we could continue to see further resiliency. But we also have to be mindful of a couple of things that could sort of derail us if they were to be fully implemented, i.e., tariffs specifically. Now, if we look at the following page, this, of course, does put well, before we get to the Federal Reserve, I wanted to spend like 20 seconds on oil markets. I wanted to have this in here. There's been a pickup in geopolitical risk as well. And in times past, the U.S. economy was more susceptible to geopolitical risk picking up. And usually that had something to do with the fact that if there was a pickup in geopolitical risk in the Middle East, for example, or Russia in 2022, for example, then the immediate question would be, how is it going to impact the U.S. economy? And usually the answer to that was oil prices. If we see a real spike in oil prices, you can see off to the left-hand side of this chart, we saw a pickup in specifically like 2008, where a barrel of oil got up to about $150 a barrel. Obviously, 2008 was a particularly tough time for markets. So to have to also absorb this idea that as a consumer, if we remember on the previous page, the consumer is the backbone of our economy. If oil prices and gas prices shoot up so much that then we're not spending in other segments of the economy, then of course that potentially puts the economy on its heels a little bit. Now, the good news is that the U.S. Oil production is pumping out more oil than it ever has, and it continues to increase at close to a double-digit rate of production each year. And so, to the right-hand side of this chart, we are now actually, as an economy, as an oil producer, net producer of oil. And that is not something that we've been able to say on this chart going back, 50, 60 years, where we were having to import a lot of oil, which then made the U.S. economy more susceptible to some shocks around the world. And so I, at the very least, wanted to address this, given the shakeup and some of the geopolitical risks taking place in the Middle East, again, specifically between Iran and Israel, and the potential for some of that contagion fear to take place. The good news is that we are fairly isolated as a U.S. economy, and oil is not having to be an issue that we've dealt with in the past. So I certainly wanted to address that whilst we're on the U.S. economic story. Now, if we look at the following page, we had talked about inflation. And one of the biggest things that is coming up all the time is the question of, will interest rates fall further? This is the job of the Federal Reserve, Jay Powell, the Fed chairman, as to if they feel it's necessary for rates to come down. Now, as you can see on this chart, which goes back, 30 plus years or so, rates are, sometimes go up and down like a yo-yo. When everything is doing really well, sometimes you're seeing a higher interest rate environment just to ensure that bubbles don't form and things don't get ahead of themselves. Like there's just too much excess in the system, right? If you blow too much air into a balloon, that balloon pops, right? We don't want to have that, right? So there are times when the Federal Reserve will take some air out of that balloon by raising interest rates. And then there are times, as you can see on this chart, where rates effectively go to, down to 2%, 1%, 0%. And those are typically at times when the U.S. economy is in a recession. Now, if we've looked to the right-hand side of this chart, I had mentioned the fact that interest rates had started to increase in 2022. Why was that? Because the Federal Reserve was trying to combat that inflation problem. There were some excesses out there in the system. And in order to bring inflation down, the Federal Reserve always has that tool in their tool belt of raising those interest rates. And in the last year or so, the Federal Reserve has begun to actually reduce those interest rates. In other words, they sort of topped out a little over 5%. That made borrowing a little bit more expensive, obviously, or a lot more expensive if you were trying to buy a home. That was all intentional. That was trying to sort of take some of that excess out of the system. But the reality is that interest rates don't need to stay that high if inflation is under control. And as far as the Fed was concerned, coming into 2025, that inflation was getting under control. And so they actually begun to reduce those interest rates. And you could see that really effectively felt across, CD rates coming down a little bit. You could see that in mortgage rates maybe coming down a little bit. Any sort of borrowing that was going on, those rates weren't as high as where they were, say, a year ago, a year and a half ago. But the Fed is in a tougher position now coming into the second half of 2025 because as inflation is starting to perk back up again, the Federal Reserve, if they were to further cut rates, that could exacerbate inflation actually, because when the cost of borrowing is cheaper, that just gets the economy going even more so. The economy doesn't actually need a whole ton of help right now, as we've talked about in some of these slides. The economy has been growing, albeit slowly. People have been spending, and so the Fed right now is not in a position where they feel inclined to want to cut interest rates. And so the market would always, as well as the administration, would like rates to be lower, but the Federal Reserve has to keep a fairly, or 100% an independent view of where rates should be in their eyes. And as far as they're concerned right now, the inflation story they'll keep an eye on. The U.S. economic story is okay, it's growing, and the U.S. employment picture also continues to look, quite healthy as a whole. And so rates ultimately will be lower in the future, but for the time being, why all of this is important is because if we have fixed income in our portfolio, then we're getting paid for being there today. And fixed income is a very important diversifier in our asset allocation mix. Of course, we probably have stock exposure, but bonds are giving us a diversified source of income today that we weren't getting when rates were at 0%. And as long as the Fed keeps these rates fairly elevated, then from an investor point of view, that very likely just means that coupon yield that we're getting off our fixed income should continue to stay elevated also. We don't anticipate a lot of movement on interest rates in 2025. Maybe a quarter basis point cuts, maybe two, but not any more than that. And so we should be in an environment, we think, where interest rates stay elevated until the Federal Reserve feels either the economy needs a little bit of help and they'll cut interest rates, or, and this may be the preferred target, inflation does get back down to the 2% level that they're looking for. And then they can really begin to, continue to cut interest rates. If we look at the following page, and to tie a bow on everything, and then Lindsey, happy to open it up for any questions if there are any. We like to close out with this chart here on asset class returns. We call this the jelly bean chart. We call it the quilt chart. There's a lot of colors on this chart, and each color represents a different asset class to invest in. And this goes back about the last 15 years, from 2010 to even where we're at right now, all the way off to the far right in year-to-date returns. And the reality is that you find these colors bounce around all over the place. And so when we say it's very difficult to time the markets, look no further than this chart, because what's at the top one year could be much lower the next. What's on the bottom one year could be much higher the next. It's very difficult to sort of determine what's going to be at the top and what's going to be at the bottom. So what we've done on this chart is we've simply taken a mix of all these different style boxes, all these different investment asset classes, and we've just made up roughly a portfolio that's about 60% stocks and about 40% bonds. And that is that asset allocation portfolio that you see down the middle, that sort of black line. And as you'll find, it's never at the top and it's never at the bottom. But it does take a lot of the timing and a lot of the emotion out of what is, as we talked about, a very, very noisy environment right now. If we have a good mix of all these different asset classes, then we're going to participate and have a lot of the upside when it's there. But we're also going to be able to play defense in the event that something goes awry, a black swan event, as they say. And we diversify not for what we can see, but it's for what we can't see. It's what's lurking around the corner that potentially wants us to make an investment decision that is deemed as irrational. And so it's really important to stay balanced and have a good mix of asset allocation. And as I mentioned to Lindsey at the very front end of this conversation, when we had a chance to catch up for a moment, all the way off to the far right, you can see this year, you've got the gray box, which is international developed market equities. We talked a lot about that and the success of that. And the green box is large cap US stocks. And you've got fixed income in the dark blue. These numbers are all reflective as of June 30. If we were actually looking at the numbers as of yesterday, all of these numbers are actually higher than what you see on this chart. In fact, there isn't an asset class on this page that is actually negative year to date. And I think that probably goes against the grain of a lot of investors that have had to digest all this noise and all the impact that noise may have had on their portfolio. And again, it's really important to segment out what that noise is and the reality of what our portfolios actually could look like. So with that, Lindsey, thank you again so much for having me. I will turn it back over to you and see if there's any questions.
Great. Thank you so much, Justin. Appreciate the insight and the information. The charts are always a nice way to kind of process some of that. I do have one housekeeping thing. Julia on my team said that we missed the opening slide that had our disclosure on the recording. So Katie, who's helping behind the scenes too, if we could put that back up before the end, we would really, really appreciate that. Sorry, Katie, I know you just stopped sharing, but one of the things that's interesting about that last quilt chart that we had is just, kind of while everything was sort of all over the place with asset classes, the white ones, which is showing that, kind of balanced allocation, how that really shows what our objective with active management is. It sort of narrows the returns. There was never a time it was at the top, and there's never a time that it's at the bottom, but it really helps to make it a bit more predictable. And I think it's a good reminder to clients that that's really what our objective is to kind of live more in that in the middle. Obviously, we'll have instances where we have exposure to some of the asset classes that are, higher or lower, like the cash one. There's reasons to have more in those buckets, but that sort of allocation picture really paints it well with what our objective is. One of the things, Justin, that even as you're talking and saying all these things that logically make sense for where we're at and what is happening, I feel like there's sort of this disconnect between what's happening in the markets and what people are feeling from maybe just kind of the level of uncertainty that's out there. So when we think about the second half of the year, I don't think we're expecting for, the uncertainty or, kind of the variability to go away. What are some of the things when we think about just, obviously we talked about staying invested and having that broad allocation. But, for people on here that are saying like things just still don't feel good, I'm having a hard time with that level of conviction. Is there anything you would add to those comments?
Yeah, it's look, I think if you how you get your news these days is relevant to maybe how we think, right? And it's difficult to turn things off at times. And so we're very sensitive in terms of how people are feeling about the state of the world or the state of politics, right? What has really been the backbone of from at least from an investor point of view, it's really important to just get a sense as to, well, why does the stock market go up, right? It's a question that we should be asking ourselves amidst this noise. And A lot of that is driven, of course, by the companies that we're investing in, and we obviously focus on very high quality, very liquid um, companies that we would want to own for a long time. And so, if I'm an investor here in 2025, I want to be mindful of what's going on. I want to take in the noise, and I want to be sensitive to what's happening. But when we buy a stock today, we're not just buying that stock for next quarter's earnings or the next 2 quarters earnings. We're buying that company for 2026 and 2027 and 2028 and beyond, right? And so when we think about the companies that we're, it could be the phone that we buy, it could be how we consume, where we buy things from. If you think that that company is going to continue to do well, then a lot of optimism is born off of that, right? And so if we sort of are in this bubble of what's happening over this next week or two, or what I saw today, then that can derail us from thinking about what the longer term objective is for a company that may be continuing to do amazing things a year from now, 2 years from now, 3 years from now. And so with that thought in mind, a lot of the optimism that you may see in any given year is investors saying, you know what, 2025, it's a challenging year. There's a lot of noise, but I'm focused on 2026. I'm going to focus on 2027. And I really believe in this company. I really believe in what they're doing. And that, if we can think about it from that angle, Lindsey, then perhaps it allows us to have an informed, more optimistic outlook on where things stand, even in the midst when it doesn't feel good
Mhm.
at the moment.
That's such a good reminder. We were talking about that analogy of the house and some of the pricing, whether it be in the attic or the basement. But there's, the other two floors of the house where there's a lot of companies that live that, there's still good value in them, even if they're not driving the market or undervalued. There's still sort of a lot of core companies out there that are going to continue to have, consistent performance. And so, we hear about some more extremes really when we think about the market, but good reminder that that the bulk of the house really is not getting a lot of the headline news.
It's it's really important you mentioned that. And I also think it's important for us to realize that if we were sort of in a pre-COVID environment, there weren't actually a lot of asset classes that were working um, well together. Like large cap growth stocks, tech stocks were doing very well again pre-COVID. But you looked around the world and international wasn't doing well. There wasn't any fixed income or any income in fixed income. Rates were very low. And so you were sort of asking yourself, like, where do I actually go here if I want to have a good diversified portfolio and actually make some money at the same time? And I think if you fast forward to where we are now in this environment, as hopefully some of these slides indicated today, there are opportunities in U.S. equities. There will continue to be. But there are also opportunities in global stocks today. There are also opportunities in fixed income and bonds that we have in our portfolio. And so it's not this idea that we have to be in just one spot. We can, if we're feeling inclined to take risk, we can do so. If we feel inclined to want to play a little bit of defense in our portfolios, we can do that as well and still actually get paid and make some money. And so that is a difference from where we saw just things 5 or 6 years ago in sort of the lead up to COVID and beyond.
Yeah, and just a good reminder to everyone on the call that that's what we hire these portfolio managers to do, whether it's JP Morgan or a different manager that you have in your portfolio, is there behind the scenes looking at all of that to say, where should we be currently? What are we looking forward to? Because I think that's one of the things that people find challenging about the market is that it's forward looking. So as you said, what we're living in right now isn't necessarily what the market's reacting to. And so just a good reminder that, we have these, companies that do that and have large teams of individuals that are looking much deeper than just what's happening on that headline news side of things. So Great. Well, Justin, we really appreciate you taking the time, and it's been a wild start to the year. So, we'll all be curious to see what happens for the second half and where we finish 2025. But it sounds like there's, from JP Morgan's perspective, still optimistic about where the year will end, and then we'll be turning the page and looking at 2026 before we know it.
Thanks for having me, Lindsey.
Yeah, thanks so much. Have a great day, everyone. Bye.